Welcome to Financial Success Blueprint. If you enjoy the channel, please subscribe and give this video a thumbs up. Without further ado, let's dive right in. 1. What are index funds and how do they work? Index funds are a smart and cost-effective way to invest in the market. But what exactly are they and how do they work? Imagine you want to invest in the stock market but don't have the time or knowledge to select the best stocks or bonds. Additionally, hiring a financial advisor can be expensive. This is where index funds come into play. An index fund is a type of investment fund that tracks a benchmark index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq. Instead of a portfolio manager individually selecting and buying stocks or bonds, the index fund replicates the index it is based on. For example, if an index fund is based on the S&P 500, the fund will invest in the same stocks that make up the index in the same proportions. This means that the fund's performance will closely follow the performance of the index, minus the fund's expenses. Well, the S&P 500 index has provided an average annualized return of around 10% since its inception in 1926. It's important to note that this performance is not constant, and there have been years when the index has had negative returns or returns well above the average. The advantage of index funds is that they usually have much lower expenses than actively managed funds, as they don't have to pay a portfolio manager to actively select and buy stocks or bonds. Additionally, by tracking an index funds offer greater diversification and reduce the risk of an individual investment in a single company. Another advantage is the ease of investment. Index funds can be easily bought and sold through brokers or online investment platforms. 2 advantages of investing in index funds over other investment funds. Firstly, index funds are based on stock market indices such as the S&P 500 or the Dow Jones Industrial Average, which means they are composed of the same companies that make up those indices. This offers a significant advantage for investors: diversification. By investing in an index fund, instead of buying individual stocks, you have the opportunity to invest in a broad set of companies, reducing the risk of loss. Another major advantage of index funds is that they have low management costs compared to other investment funds. This is because they do not require an active manager to select and buy stocks, which means you don't have to pay high management fees. Instead, the index fund simply tracks the corresponding stock index, making it cheaper to manage. For example, let's suppose $10,000 is invested in a mutual fund that charges an annual fee of 1.5%. If the fund had a 7% return over the year, the investor would have earned $700 in interest but paid $150 in fees. Therefore, the investor would have a net return of $550, representing a 5.5% net return on the gross performance. On the other hand, if the same $10,000 is invested in an index fund or ETF that charges an annual fee of 0.1%, the investor would only pay $10 in fees. If the fund had the same 7% return over the year, the investor would have earned $700 in interest and paid only $10 in fees, resulting in a net return of 6.9%. Additionally, index funds tend to outperform actively managed funds in terms of long-term performance. According to various studies, index funds have shown to outperform actively managed funds over the long term. This is partly because active managers often struggle to outperform benchmark stock indices and, as a result, cannot justify the higher fees they charge. Lastly, index funds are easy to understand and invest in. You don't need to be a finance expert to invest in them, and in many cases, you can do so through an online investment platform or your bank. Let's imagine 2 friends, John and Peter, who decide to invest in the stock market. John decides to invest in shares of various companies that he finds interesting and exciting, while Peter chooses a diversified index fund that tracks the S&P 500 index. In the first few months, John gets very excited about the market ups and downs, closely follows economic and financial news, and feels thrilled about his investments. In contrast, Peter doesn't pay much attention to his index fund and feels a bit bored with the lack of excitement in his investments. However, after a few months, the market experiences a correction, and John's stocks plummet, while Peter's index fund remains stable and doesn't suffer as much from the market downturn. John feels discouraged and frustrated to see that he has lost a lot of money in his investments, while Peter feels more at ease knowing that his index fund is diversified and has a long-term strategy. In summary, investing in individual stocks can be exciting and fun in the short term, but it can also be risky and lead to losses. On the other hand, investing in index funds may be less thrilling and less exciting in the short term, but in the long run, it can be a safer and more profitable strategy. 3. What is the best time to invest in index funds? When it comes to investing in index funds, One of the most common questions that arises is, what is the best time to do it? In reality, there is no definitive answer to this question, as the timing of investing in index funds depends on various factors that can vary from person to person. In general, most financial experts agree that the best time to invest in index funds is as soon as possible. This is because, in the long run, index funds tend to offer good returns and have relatively low risk compared to other types of investments. Additionally, the ideal timing for investing in index funds may depend on your personal financial situation. If you have outstanding debts or need liquidity for immediate expenses, you may want to postpone your investment in index funds until you have more flexibility in your budget. On the other hand, if you have a stable financial situation and are looking to invest for the long term, index funds can be an excellent investment option. In general, experts recommend regularly investing a fixed amount of money in index funds rather than trying to time the market and make large investments at specific times. How long would it take to achieve financial freedom with index funds, assuming an average return of 10% from the S&P 500? Let's assume the viewer is 30 years old and decides to invest $10,000 in a diversified portfolio of index funds, following the long-term investment strategy described above. If we assume an average annual return rate of 10%, and consider that the reader doesn't make additional contributions, in 20 years they would have a portfolio of $73,280. However, if they also make monthly contributions, let's say $350, the time needed to achieve financial freedom would be significantly reduced. With this strategy, at 20 years they would have $341,274 and at 25 years $588,831, which along with the 4% rule would allow them to attain financial freedom. What is the 4% rule and how would it be applied in this case? The 4% rule is a general guideline used by some investors to determine the amount of money that can be withdrawn from an investment account each year without significantly depleting the initial capital. According to this rule, one can withdraw 4% of the initial capital each year to maintain the purchasing power of the initial capital and have a high probability of the capital lasting for an extended period of time. In the previously mentioned example with a 10% annual return, the €341,000 would grow by 10% each year, which would amount to an additional €34,100 in gains, resulting in a new balance of €375,100. However, if €13,640, 4%, is withdrawn for expenses, the new balance would be €361,460. In the second year of applying this rule, the 10% return would be applied to this new balance, resulting in an additional €36,146, making the new balance €397,606. If €13,640 is withdrawn again, the new balance would be €383,966. By following this strategy, the portfolio should continue to grow, and the 4% withdrawal amount would increase over time, ultimately allowing for achieving financial freedom. For the power of compound interest is one of the most important concepts in the world of finance and is key to building long-term wealth. Compound interest is the ability to generate interest on previously earned interest, allowing your money to grow exponentially over time. This principle applies to index funds as well, where the accumulated earnings are reinvested, allowing you to defer taxes until you withdraw the money. Albert Einstein is often attributed with the quote, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Let's delve into the significance of this quote. Imagine you have $1,000 saved and decide to invest it in an account that offers an annual interest rate of 5%. After 1 year, you would have earned $50 in interest, resulting in a total of $1,050 in your account. But here's where it gets interesting. If instead of withdrawing the $50 of interest, you leave it in the account and reinvest your entire balance, the interest in the second year will be applied not only to the original $1,000 but also to the $50 you earned in the first year. By the end of the second year, you would have $1,102.50 in your account. If you continue this pattern of reinvesting your entire balance each year, after 10 years you would have $1,628.89. That's 62% more than what you would have if you simply reinvested your interest each year. And if you maintain your investment for 30 years, you would have a staggering $4,321.94. That's more than 4 times your initial investment, thanks to the power of compound interest. Compound interest is like a snowball rolling downhill, growing larger and larger over time. It's crucial to start investing as early as possible to maximize the benefits of compound interest. The longer you keep your money invested, the more it multiplies. Furthermore, compound interest enables you to achieve your long-term financial goals. For example, if your retirement savings goal is $1 million, compound interest can help you reach that target faster and with less effort than you might expect. In the following video, we will analyze different index funds, where to buy them, and how to implement a diversified strategy. If you enjoyed the video, don't forget to subscribe to the channel and turn on notifications to stay updated on every new episode. This video does not provide professional financial advice. Always consult with an expert before making significant financial decisions.